are some who say that the biggest barrier to long-term mass adoption of Bitcoin is price volatility. This is because it limits use as a store of value. So, does price volatility really affect Bitcoin's use as a store of value? Let's look at some basic economics. Store of value is a Bitcoin long-term perspective, and while it does have an effect on it as a medium of exchange, if you're buying and investing as a store of value, that would be more than a year. How Bitcoin has performed in the last year, up about 600%, makes it a very good store of value. However, that's not what store of value means. So let's take a closer look, shall we? Historical value. Would-be investors have been kicking themselves for well over 2 years as the price of Bitcoin soared to new all-time highs in late 2017. And it continues to be a very lucrative investment, unless, of course, you bought in at all-time highs. Investors who bought $100 worth of Bitcoin a year starting in July 2010 would now be looking at over $2.7 million today. An investment of $100 per month starting in July 2014 would amount to 9 Bitcoin, worth $6,100 today. The same amount starting in July 2016 would be worth over $10,000 for a $2,400 investment. Of course, an investor that bought in at all-time highs in December 2017 would have lost money. That's often the case when one invests with the fear of missing out as the driving force. Volatility. Regulators don't control volatility in currency. If anything, regulated markets that don't have enough flexibility and liquidity are even more volatile. This indicates that the small size of Bitcoin as a currency is probably the largest contributor to its volatility. As Bitcoin gets bigger and the market becomes more liquid, that will reduce volatility. As for Bitcoin long-term stability, the more it's used for purchasing or selling, the more companies will depend upon it as input, thus reducing the price volatility. Currently, Bitcoin is mostly used for speculation on a short-term basis and traded globally in a wide open market. The result is quite volatile, but Bitcoin will become less volatile as it grows. Growth. Bitcoin isn't a debt instrument like other currencies or cryptocurrencies. When you hold Bitcoin, nobody owes Bitcoin to another entity or person. It's an asset. Most other systems we use for money are actually debt instruments created through credit. You have $1, somebody owes somebody else for that dollar and is holding a debt. Bitcoin is a very different system. Another huge difference is the lending done through fractional reserve banking with traditional currencies. In other words, the creation of money out of thin air by banks lending $10 for every dollar they hold in deposits allows them to expand available credit or inflate the economy by producing more credit. If properly invested, that credit might increase productivity and create returns, but if not, it creates bubbles and inflation in the underlying currency. Choice. Bitcoin is an opt-in, voluntary system that no one has to use. The problem with monetary policies of nations is that you can't opt out of using the currency. Also, the policies change at the whim of bureaucrats. There's no choice to pick any monetary policy or currency to use on a day-to-day basis. You can be locked out of a system, your assets can be held hostage, and you have no exit. Bitcoin's monetary system is relatively unchangeable within Bitcoin, but you don't have to use it. Bitcoin long-term and short-term is about choice and not about replacing central banks with a deflationary monetary system that's imposed on everyone. If you're interested in learning more about Bitcoin, visit our site today. And if you enjoyed this video, don't forget to like, comment, and subscribe.